G'day folks, Jim here from Orchard Forex. It is Saturday the 17th of April. Well, what we suggested in last week's video turned out to be pretty much the case, in that we saw a softer US dollar and stronger stocks and commodity prices, all helped along by the slightly lower bond yields, coupled with some bumper Q1 earnings from the US banking industry and some very robust economic data, particularly from the US. Looking ahead, more of the same would seem likely in the coming week, given the current Goldilocks scenario for financial assets as the world begins to open up again following the pandemic. And I remain positive for stock markets in particular. While the recent run of very strong economic data should remain supportive for the positive risk mood, for the coming week, the short-term charts, particularly in the FX markets, suggest that it could be a choppy couple of days ahead, in the absence of any major data until Thursday, when the ECB will meet. And then on Friday we have the manufacturing PMIs, which should give us a bit more of an outlook as to what might happen the following week. So in the meantime, we'll go and have a look at the charts, and as usual we'll start with a quick look at the dollar index. Okay, so here we have a daily chart of the dollar index, and it closed down near these previous March lows. It's holding on at the moment above sort of 91.35, finished the week at 91.50. If it does go below here, the 100-day moving average looks to be in line. That's down around 91, the figure, and below that we find support at this rising trend line. That's way away at the moment, 90.25. But the indicators, the daily indicators, are pointing south, so I think the dollar is likely to remain heavy in the coming week. Having said that, we haven't got much on the calendar out in the first few days of the week, so it could just end up being choppy. And the weekly charts actually still look quite positive. We're going to have a quick look at the weeklies, and as you can see, the momentum indicators are still pointing higher, although they might be running out of some steam. So while I do remain slightly bearish on the dollar in the near term, I'm turning a little bit neutral further out, and it could just be that we chop around here. As far as the euro is concerned, and we'll have a look at that in a second, I think we're close enough to 1.2, 120, and I think we're going to test that in the coming week just to see what stops lie above there, if nothing else. But beyond sort of 120.5, 121, I'm not really sure whether the euro's got the legs to really power on higher. So without further ado, we will go and have a look at the euro. Okay, so we'll start off with a 4-hour chart of the euro, and as you can see, really for the last couple of days of the week, last week, it really just chopped around. It was unable to break above 120, 119.92 looks to have been the high, tying in with these previous highs back here in March. Personally, I think we're probably likely to take them out at some stage, just to see, as I said, what stops lie above 120, with 120.25 and then 121 being obvious points of call. Personally, I think I'll probably be looking to sell into if we got above 120.5, certainly I think I'll be looking to sell into it. But the indicators, the 4-hour indicators, are not telling us a lot. It's a very thin calendar to start the week off. The ECB lining up on Thursday, of course, but ahead of that, it might just be more of the same of this. As far as the daily charts go, the indicators do look slightly positive, if anything, not really showing us an awful lot. But we're sitting here right on the 55-day moving average and bracketed by the 100-day at 120.50 and the 200-day just above 119. So that could well cover it. But while the daily indicators do point a little bit higher, I suggest that we're probably going up here. As I say, sell it between 120.5 and 121. I'd have a stop loss if we saw a daily close above the 100-day moving average. I'd probably look to go with it, looking for the next set of resistance, which should come up here around this 120, 140, where we've got this minor descending trend line. But until then, I think 120.5 should remain a little bit toppish for the coming week. Moving along to dollar yen. Now, dollar yen in particular will remain hostage to the direction really of US bond yields. And while bond yields are coming a little bit lower, the dollar remains heavy. We've got this obvious support here around this 120.80, but I do suspect that might give away at some stage during the week. It's not looking particularly bearish at the moment on the 4-hour charts. If we move forward to the dailies, they are looking heavy. So I think we go back here to the 4-hour charts. I think if we do break this 108.80, we head towards 107 and 3/4, and below there, well, there's not an awful lot, sort of 106 and 3/4. But in the meantime, this is really all I'm looking for. I'd be looking to sell rallies above 109, and eventually I think we do push on down. Cable, I won't spend too much time on. We did make a spike low and then a decent recovery on Friday, but in the bigger picture, cable, as we look on the dailies, is really just trading sideways near this long-term line here that goes all the way back to 2018. I've got no real view on sterling. The weeklies look a little bit heavy. The dailies are doing absolutely nothing. So as far as trading sterling goes, I actually prefer to be in euro sterling, and we'll go and have a look at that in a second. As far as the Aussie is concerned, well, last week it was trading at 76, and I said I did think it was going to break above this resistance, which it has, but having done so, it is really just chopped sideways. It's not doing an awful lot. And the 4-hour charts actually do look a little bit heavy. I wouldn't be surprised now to see a bit of a pullback towards the sort of 77, the figure, 76.90, something like that. I'd be looking to buy it down there, I think, because I think as the stock markets head higher, which I think they're going to, as positive risk sentiment continues to be a major theme in the market, I think the Aussie can head higher and will eventually move towards this sort of 78, 40, 50 level, beyond which we might see a move back towards 80, but I think that's too far off at the moment. There's a little bit of Aussie data out this week. I think the retail sales are coming up. We'll have a look at the calendar in a minute, but overall, I think because of the positive attitude of the market for the time being, I do like the Aussie a little bit higher. If we were to go below sort of 76 and 3/4 again, which was this kind of breakout level, then I think all bets are probably off, and we may see another dip back down towards sort of 76, maybe possibly even down to this 75.35, but I'm not looking at that at the moment, and prefer the idea that we're probably going to break above this sort of 77.60 level that we saw last week and head on to sort of 78.40, 50, as I say. Okay, so that's about that. I'll have a quick look at the Kiwi. Here we are, the 4-hour chart. As with the Aussie, the Kiwi has been pretty choppy until it made a break to the top side midway through the week, and it's now looking a little bit toppish on the 4-hour charts. As far as the dailies are concerned, though, we're sitting right on the 100-day moving average, and we really need to break above that in order to build momentum. The daily charts do look mildly positive, so if we can break above this 71.80 level, we could possibly head up back to sort of 72 and 3/4, and possibly above 73, but I'm not really looking for any great movement early in the week. Once again, though, I prefer to buy dips, and I'd probably keep a stop loss for now somewhere below, well, it's 71.40 at the moment. Maybe if it got below 70.5, I'd probably be out of it. Certainly below 70 cents, I don't want to be long. Now, moving along to the stock markets, and here we have a daily chart of the S&P 500. And really, the theme is just don't argue with the bullish market. The longer-term charts certainly are becoming somewhat overbought now, but the dailies are still pointing higher. And so I think you've just got to go with it. And the markets, I think, are probably going to continue to just drift a little bit higher day by day until we see a sustained rise in inflation, at which point I think we'll see probably a fairly nasty correction as the possibility of the Fed hiking rates comes into picture. I mean, the Fed are not intending to do anything, so they say, until 2024. So if we continue in this vein until then, we're going to be an awful lot higher. But the state of play, as far as the economic data is showing us, the Fed are going to have to act far quicker than they've previously been suggesting. In the meantime, though, as I say, just go with the flow and stay with it. As far as the Aussie market's concerned, here we have a chart of the ASX 200, and we're making a real effort to break above the top of this channel that we've been sitting in, and we have done so. We finished the week above the high of the channel, and maybe we do just push on higher. The 4-hour charts not showing us a great deal at the moment, but the Aussie it's a bit of a slow burner. But I think as demand for Australian mineral exports grows over the course of the year, we'll possibly play some catch up here. If we look forward to the daily charts, this FIBO level here is a FIBO extension, and we've come to sit right up against the 0.382 FIBO extension of the rally from here up to here, back down to these lows here, and we're sitting at 382. Now if we break through those, then let me actually just blow this up a bit. So we need to break through this sort of 70-90 level. If we can get through that, then the next port of call is the 50% extension. That's 72.35. So that's some way away at this point in time. But with this high back here being at 7,200, that's well, that comes in before the 50%. So this high here which was the all-time high for the Aussie stock market. That's going to prove significant if and when we get there. The daily charts, as you can see, the momentum indicators are generally pointing a little bit higher. So I remain positive, and I think we are going to break above 71 early in the coming week. The weeklies are also, well, they look as though they might be trying to point higher to get us back to this 7,200 level. But as I say, I think it could be a bit of a slow process. We shall see. We'll have to wait on that. But I'd rather buy dips. And as far as stop losses on the downside are concerned, go back to the 4-hour chart here. I think Friday's low, that was at 70.22, 70.20, something like that. I can now keep stop losses below there. If we go back below there, then we might see a bit of a deeper dip. Okay, so that's about it. I won't go through all the other stock markets. There's too many of them. But I will look at gold, which was interesting last week. We got that right. It did break above 1755. Let me just find a gold chart. So this resistance is what we were looking at last week. We saw a bit of a dip early in the week, but eventually we were able to take out this 1755 level, and we've been as high as 1783 before settling that into the weekend around 1770. Now this is just an hourly chart. The hourlies are pointing a little bit lower. I don't really look at the hourlies too much. The 4 hourlies remain positive though, so I think you buy dips. It's a bit of a messy chart because there's two sets of FIBO here. We've come up to rest up against the 38.2% of this move here, but once we take that out, 1785, there doesn't seem to be an awful lot to me until around 1820 to stop further progress. So once again, I do like to be long. The 4 hourlies are pointing higher, as you can see, and the dailies likewise seem to be pushing on up as well. We've got the 100-day moving average here at 1800 or 18, yeah, about 1800. So just bear that in mind. But if that can be taken out, then I think we do move on to the next FIBO level, as I say, at about 1815. Finally, I'll take a quick look at silver. Silver had some big moves last week, and actually is leading the gold market a bit higher. It traded up to what, 26.25 on Friday, finished around just below 26. But I think the 4-hour indicators look positive. We've broken above the 100-day move. Is this a 100-day? No, it's a 4-hour chart. Forget that. The daily charts. Sorry, here we are. We've broken above the 100-day moving average, and I think we can push on through. The daily indicators look generally positive. The weeklies are flattening out. They've been negative for quite some time, really, but they do appear to be flattening out a bit. So I actually like the idea of buying dips in silver, and I would now put a bid in somewhere around, if we saw it down around this sort of 25.5 level, I'd be looking to buy it there for a move above 26.25 and up at least to this 26.5. If we can get above there, then it's anybody's guess. These highs up here, so 26.80, 27 around there. So that's generally the direction I think we're probably going to head in. Finally, we'll have a quick look at oil. This time last week, oil was hanging around either side of $60 a barrel, but it had a good move midweek, and it's since then it's sitting here around 63. The 4-hour charts are looking a little bit toppish at the moment, so we might come back towards 60, but I think it's probably a buy if we do sit down there. The dailies aren't really telling us a lot though, so I'd be somewhat circumspect. In a bigger picture, I think this 66 and 56, so you've got a $10 range, but I'd be looking to sell into strength with a stop loss. Well, you probably keep your stop loss above this 67.90 level, but I'll be looking to sell into strength as we approach 66.5. On the downside, if we saw a dip towards 60, I'd be looking to buy with a stop loss below this sort of 56. I think there's better things to trade than oil at the moment though, and I'd probably steer clear of it and just use it as a range trade idea. So finally, we'll go and have a quick look at the calendar for the coming week. Okay, so as far as the calendar is concerned, as you can see, we don't have an awful lot really Monday or Tuesday. We've got the PBOC interest rate setting. That won't affect the market too much. We have got the RBA minutes on Tuesday. UK unemployment Wednesday, so that might move cable around a bit. We've got some inflation data during the week though, starting off with the Kiwi data, and then later in the day we've got the UK's inflation data, as well as Canada, which I don't really cover, but it's important nonetheless. Thursday's the real big day. We've got the ECB interest rate decision and some secondary US data, I should say, and home sales, some regional Fed data coming out of Richmond and Kansas. And then on Friday we've got the PMIs, starting with Australia, services, manufacturing and composite, and then heading through to Europe and the US. So that's about it. There's not an awful lot to go on this week. Of course, the major theme will be the US, or the continuation of the US Q1 reporting season. Having said that, the upcoming week I think is probably middle of the road stuff. The really big ones, the big tech stocks, the FANG stocks, they're all going to be reporting next week. So and that's, I think, when we could see some real action on the back of the reporting season. So we'll leave it there for now, folks. Have a very good week's trading, and we'll talk to you next week. Cheers.